and then we'll get started here. A lot of big news today, not just on today's primary topic, which is hedging a little bit, but some big news in the cannabis space, which, unfortunately, the cannabis stocks that I am invested in, they're not available for purchase on M1 Finance, which is my public YouTube portfolio, but I am invested in my private portfolio heavily into some of these cannabis tickers. So I will be going over those as well. I wasn't planning to, but we had some interesting news drop today, so just a few hours ago. So I will be going over that a little bit as well. I guess we'll go ahead and get started. Does everything sound okay? Is my audio good? It appears everything is working. So we'll start by doing just a quick recap of the portfolio. This is my public YouTube portfolio. We invest in a different company every week. Been doing $200 since the beginning of 2026. Over 2025, we did $100 per week. And actually, I misspoke. We're doing $200 into a new company and then $50 into an existing company. So $250 per week starting in 2026. And the portfolio is up to $12,000, which is a cool milestone to hit for a portfolio that's just over a year old, a year and a quarter. So let's look at how we are comparing to the S&P 500, because that is my benchmark that I'm trying to beat all time. We are beating the S&P 500. So like I said, this portfolio started in December of 2024. That's the very first date, end of December. So we're up 27.11%. The S&P 500 is up about 20%. If we look at the year to date, it looks like we are also winning on the year to date. So the portfolio is performing very well. And we don't just have a couple holdings. At the beginning we did, because we're investing at the beginning, we don't have anything and we're investing in a different company every week. So at first we were pretty volatile, but as we've added more and more holdings to the portfolio, we have been moving a lot, much more correlated with the broader market. But we are looking to beat the market long term. How many holdings do we have in the portfolio now? We are up to 57. So my game plan is every quarter, essentially, I'm going to review all my holdings and basically rebalance the portfolio, sell companies that are now overvalued, maybe rotate those funds into companies that have become even more undervalued, and just continue that iterating process, buying more companies, and then every quarter kind of reviewing them. And that's the current game plan. So also we're going to try to review companies as they have earnings reports that come out. So within a week or so of the company having like a new earnings report, I always like to check, because now there is more information that is current for me to make an informed decision off of. So I like to avoid investing in companies when they are just a week or two out from having an earnings report. I like to wait for that new information to come out. So let's get on to the primary topic, though, of today's video. Done looking at the portfolio for now. We will return to that. So in the title of the stream, we say we are looking to hedge a little bit against recession. And the context that I'm talking about here is the Iran war. We all know that energy is being restricted. So something like 15 to 20% of the world's energy supply comes through that strait, which is being contested, is being blocked off. Iran is attacking merchant ships that go through. So because of that, they don't have to hit every single ship. They just have to hit just enough. They have to threaten just enough ships to where insurance companies don't want to insure ships to go through that strait. Companies, it's not worth the risk to them. So it really stops traffic. And the type of recession that will ensue is not a recession because there's low demand like we had during COVID, where the world stopped. So there was way less demand for fuel. So we have to also think about the type of recession that we're at risk of having. In this case, it's a supply related recession. So, if the strait is closed off and we're losing a quarter of our oil supply or whatever it is, our energy supply, then we have a supply based recession. Prices go up. So the natural idea is to invest in an energy company, one that will benefit from the rising cost of energy. And it is incredibly difficult to find energy companies that are still undervalued at this time. I looked through so many, and ultimately I did find a company that I was very excited about, but I ended up going a different direction. A lot of times when I'm looking to find value, I'm looking at companies that are incredibly undervalued, and normally they're not like super high, like they're not the highest quality of company, because the highest quality, the most consistent companies with great balance sheets and strong moats, a lot of times these companies are trading at a premium. So for this week, I was really excited to find what I'm considering to be a premium company that's actually trading at a slight discount to its intrinsic value, or at least according to my calculation of its intrinsic value, which I like to use a discounted future free cash flow valuation. So this company that I'm looking at today is Enterprise Products Partners LP. This company provides midstream energy services to producers and consumers of natural gas liquids, crude oil, petrochemicals, and refined products. It operates in 4 segments. It is fairly international. They provide these products all over the world. Let's see here. It doesn't really say where they sell, but in their report, they do talk about it. So let's see. I'm pretty sure they give a breakdown of where they are supplying. There's one. In any case, I'm getting a little bit ahead of myself. So this company stands to benefit from oil prices. So the first question is, how do I determine that this is a high quality company? And then we'll talk about whether or not they're undervalued or not. So one of my favorite places to go to determine the quality of a company is the Morningstar Equity Analyst Report. And sometimes I like to just go into Morningstar and set up a screener for companies that have a wide economic moat and an exemplary capital allocation. This means that they return value to shareholders in a very strong way. They have a very strong balance sheet. They're not overextended as far as debt. A wide moat means they're going to have pricing power. They're less likely to have competition come in and eat away at their top line growth or their margins. So these are both really good. And then as far as uncertainty goes, on Morningstar, medium is the second lowest level of uncertainty. So everything about this as far as Morningstar rankings look really strong. And Morningstar is even showing that this company is slightly undervalued. So let's get straight into the spreadsheet. Let's start with the spreadsheet. So this is my automated spreadsheet. I type in the ticker. It automatically will pull information from stockanalysis.com. So right here, it pulls just all of the line items that I'm going to need: revenue, total revenue, gross profit, etc. And then on this tab, I format the data so that I can easily pull it into the next tab, which is where I run the calculations to get my discounted free cash flow valuation. And finally, on the dashboard, this is where I enter in my assumptions. So, the assumptions are a critical part of performing this analysis. So you do your due diligence. You have to have strong assumptions, or else you're going to get garbage results. So let's start with the top line growth projections. So for years 1 through 5, I've got 3.5%. For years 6 through 10, I've got 3%. And for my perpetual growth rate, I've got 3%. So essentially, except for years 1 through 5, because I'm using analyst projections for that, for the rest, I'm using inflation. Companies that are tied to a commodity like this are generally going to have their profits, their revenue. It's going to be strongly correlated with the price of the underlying commodity. And since there is a strong chance that we could enter into a recession where the price of energy goes way up because of a reduced supply, this company would be a nice hedge against that. So that's where I'm getting 3% for years 6 through 10 and my perpetual growth rate. For the annualized revenue for years 1 through 5, though, let's go back to Morningstar really quick. So if I scroll down to the bottom, they have a table where they really spell out their projections here. So for the next 5 years, here's their revenue growth projections. They are showing an average of 3.6%. For 2026, they're projecting 8.2, so a little bit of a higher increase in 2026, and then it slows down and kind of levels out around 3%. So that's where I'm getting my 3.5. I'm pulling it from Morningstar Equity Analyst Reports. And there's also a forecast tab on stockanalysis.com. So on their forecast tab, if I scroll down, I can also paste in a range of many different analyst expectations. So I also like to take this and paste it into my spreadsheet right here. So this is going to take into account a range. The average analyst expectation is roughly in line with Morningstar. So that's where we're getting these projections, and the analyst projections are going to go into this calculation right here. But for now, let's just focus on my projection. So the final assumption that I need to make here is the profitability. What percentage of their revenue going forward are they likely to turn into free cash flow? So their average over the past 5 years is 9.3%. But as you can see, I'm going with 11.5% for my initial, and then I'm saying it's going to grow at 0.5% per year for the next 5 years, and then stay at about that level into the for my perpetual growth rate. So where am I getting that? First of all, the first adjustment that I make is with CapEx. So this company has been spending a lot lately on capital expenditures. Capital expenditures is counted against free cash flow, and in this case, the company is spending a lot on exploration and expansion of their, their midstream. So they're expanding currently with heavy CapEx spending. So let me go back to their cash flow statement really quick. Financials, cash flow. So we can see that right here, CapEx. So over the last 3 years, 5.6, 4.5 billion, and 3.2 billion. This is much higher than their depreciation. So depreciation is what I'm using as a proxy for their maintenance spending. So the difference between depreciation and their regular CapEx, I'm giving them credit for growth CapEx. And so I like to count growth CapEx into their free cash flow number. And so that buffs up their free cash flow a bit, giving me an average of 11.5 after taking into account their CapEx growth spending, or the growth spending that I'm giving them credit for. So that gives me a margin of 11.5. I'm also giving them credit for 0.5% of growth over the next 5 years. The reason I'm doing that is based off of Morningstar's equity analyst report. They give margin assumptions for the next 5 years as well. And so when I look at the first one is operating margin. So 4 years, for the last 3 years, they've averaged about 13.5. Morningstar is saying they're actually going to get up into the 14s towards the end of that projection period. For EBITDA margin, they ended at 18.5. They're going to improve up to about 19.2. For net margin, they were at 10.8 in 2025. They're saying they're going to increase that up to 11.5. Free cash flow margin to the firm, this is what I'm looking at. Morningstar gives them 10.5. And they're saying they're going to grow up to 15.5 for a new 5-year average of 13.8. So for my purposes, I'm not going to give them an average of 13.8 for the next 5 years. What I'm going to do is I'm going to start them off at their average free cash flow margin from the past, and I'm going to increase it by 0.5% per year for the next 5 years. So that gives them another 2.5% over the projection period, so they end up at about 14. So with all of those assumptions in place, my calculated fair share price is $58 per share, which represents a 54% upside, which is a significant margin of safety, especially on a premium company like this that also has a very strong dividend. So if I go to the overview, this company has a 5.83% dividend. Now, when I'm valuing a company, I do not factor in the dividend when I'm calculating their actual intrinsic value, because their free cash flow is going to be distributed in many different ways. Some of that free cash flow, yes, goes to the dividend and gets returned to shareholders. Some of that free cash flow is reinvested into the company through capital expenditures. And I still view that as a return to me, because that is contributing to future free cash flow growth, which is in turn going to allow them to continually raise their dividend. So if I go to their past dividends, we can see that they have consistently raised their dividends going all the way back. See, this chart goes back to 2016. So over the last 10 years, this shows their dividends. They have raised their dividends or kept them roughly the same every single year. I guess they've actually, yeah, because this is monthly. So they have raised their dividends every single year. So it is that reinvestment in free cash flow. It's that reinvestment into things like CapEx, that organic growth that allow them to keep growing their free cash flow and therefore keep growing their dividend. And we can see how they're spending their free cash flow if we go to their financials, go to their cash flow statement right here. I can scroll down. So to calculate, to do a simple calculation of free cash flow, you take the operating cash flow. This is how much cash they got from their primary business, their operations, and then you subtract capital expenditures. Now I separated out the growth and the maintenance. So here is this is a big target for their operating cash flow. They made 8.5 billion. They had 8.5 billion come in net from their operations. They spent 5.5 billion on CapEx. And then if I scroll down a bit further, we can see that they issued debt, they paid back debt for a net of, they actually pulled out an extra $2.5 billion in debt. So we also need to check their debt profile. They spent some money to purchase stock, and then they paid dividends. So they have not only paid a lot of dividends, but they've also reinvested a lot into their business. And the way I determine if I like that they're reinvesting into their business is I go to the ratios tab and I look at their return on invested capital. So this company consistently has a return on invested capital of over 10%. So they are consistently making money off of the capital that they reinvest into their business. So if I'm seeing a company that's returning a lot to shareholders through a dividend, if virtually all of their free cash flow is getting paid out in a dividend, then maybe the return on invested capital isn't as important. But if a company is reinvesting heavily in the business, then I want to see, like, seeing double digits here is really nice. It should at least be, I like to see double digits. I'll just leave it at that. Yeah, so I like the way that they're spending their cash. They are reinvesting into their company and they're paying a heavy dividend. So, okay, I remember where I was going with this. So I don't take into account strictly the dividend. I look at the total free cash flow picture, and then I determine if I like the way that they are spending their free cash flow. In this case, I do. But one extra added benefit of a high dividend is it creates almost like a psychological level to the stock. There's lots of dividend investors out there, and when they see a stock start to hit when they see the dividend yield start to reach all-time highs, it acts as a kind of a support for the company. Investors start piling in because they see, oh, like last time their dividend reached, let's say 7%. That was the highest yield that they ever got, and then the dividend yield went down as the stock price went up. So it creates a floor for the company's stock price as long as it's continuing to operate well, which in this case it is. And according to Morningstar, if we go back up, they have a wide moat, exemplary capital allocation, which is their highest rating for capital allocation, and just medium uncertainty. So everything about this company looks really strong. One last exercise I like to do, or actually, I guess I skipped the analyst average high and low, so we can kind of see the base case, the bull case, and the bear case in terms of the analyst projections. And this is just using the analyst revenue projections. So if the most pessimistic analysts are correct, they maintain their profitability, but they lose revenue over the next 5 years. This is very pessimistic. Then we're seeing a 34% downside. However, if the most optimistic analysts are correct, then we're seeing a 150% upside. The truth of the matter is most likely somewhere between these two, roughly, we'll say 50% upside on the stock. And that is my margin of safety. What this means to me is that the company can underperform my expectations and still represent growth. So right here, I forgot to go over this discount rate. This is my target return, my annual return that I want to see every single year. So this share price is factoring in an 8.35% return every single year. So I have a 54% margin of safety to get this return. So I also like to reduce my expectations to see what set of expectations does the market have that communicates the current share price. So first thing I want to do is I want to start by removing this free cash flow margin growth. Let's say they don't expand their margins like Morningstar thinks they will. They're just going to continue being as profitable as they were in the past 5 years. So if I take that down to zero, if I no longer give them credit for that margin expansion, now the fair share price only has a 20% margin of safety. Now, 20% undervalued is still great for a top tier company like this, especially one that's positioned well given the macro environment where we could see energy shortages. So the next thing I'm going to do is I'm going to trim some off of the annualized revenue growth. If I drop that down to 3, now we're seeing a 17% valuation, or sorry, a 17% margin of safety. If I drop these down a bit further, let's say 2.5% revenue growth. So kind of maybe on the lower end, a lower estimate for inflation, it's about fairly share price. So as long as this company can exceed this set of assumptions, then I should receive a return of 8.35% per year or greater. So that is my investment thesis for this company right here. If we go to, let's see, if we go to their investor deck here, they go over production forecast. So they give a 5-year production forecast. So they're saying total natural gas production, or no, sorry, this is oil. They're saying total oil production is expected to go up by about, looks like that's over 10%. What is that? Maybe 13, 14% over the next 5 years for NGLs. What does that stand for? I'm drawing a blank. It's just natural gas liquid. What does NGL stand for? Anyway, dry natural gas, total natural gas. Let's just look at the total natural gas. So it is in 2024, it was 114. They're saying it's going to go up by 16. So that's a little bit over 10% as well. So 10% expected growth over the next 5 years. So the demand, the production forecast is up. This is their Permian production forecast. Let's see here. This is a cool little graphic where they say what comes from a barrel of Permian oil. They've got natural gas, NGLs, and crude oil. So another interesting piece on their investor deck is their fundamental outlook. So right here, they talk about, where was it? Here we go. Petrochemical destocking due to Iran conflict creates tailwinds for cost advantage crackers. So what's happening is the US and other companies are going through their strategic reserves because of the shortage. Once that shortage is over, we're going to be looking to replenish those reserves, which means not only are we going to be buying again at our regular levels, we're going to have increased buying to replenish reserves, and that increased buying, that increased demand will come also at a higher price because we will have come out of a period of reduced supply. So that is essentially what we're looking at. That is the thesis. I'm investing $200 into EPD. That's the ticker. And let's see, the next item on the list is, so that's $200 into a new company. We do that every week. Now I'm looking to invest $50 into an existing company. So let me pull up my portfolio one more time, because this week we are investing in the worst performing company in my portfolio. So let me pull it back up. It closed on me. One moment. Unfortunately, not all of our companies perform well right away. We are value investors, so I'm always looking to invest in companies that are undervalued. A lot of times a company is undervalued while it is dropping in share price, and I'm not looking to time the exact bottom. I wish I could, but that is not the goal of this portfolio. The goal is simply to buy when it is undervalued, and so we typically do not catch it at the exact bottom. So if we go to our holdings and we filter by unrealized gain, so here we have our top holdings here. Oops. No, actually I went back. Hide that. Okay, we have our top holdings, Plab and Iridium. But if I scroll to the very bottom, we have our red holdings down here that we hide down at the bottom so nobody can see. But this is factored into our total return, which we are still beating the market. But our worst performing one is Simply Good Foods. And I am going to be putting an extra $50 into this company because it is just undervalued. So let me grab my assumptions here that I saved previously. One moment. Okay, so here's the set of assumptions that I'm working with. I've got 11% free cash flow margin and just 2% revenue growth for years 1 through 5, 6 through 10, perpetual growth rate. So this set of assumptions gives me a margin of safety of 116%. So they just have to exceed this set of assumptions right here. It's just this. So first, let's look at the revenue growth. How likely is it that they are going to be able to compete with 2% revenue growth? The first place I'm going to look at is always stockanalysis.com. There is not a Morningstar equity analyst report, unfortunately. But on the analyst aggregate on stock analysis, the analysts think that it's undervalued. But if I scroll down to the revenue growth projection, so for 2026, they are projected to lose revenue, but then they are projected to gain revenue going forward. So I went with 2%, and they're insanely undervalued with 2%. Let's look at where I'm getting their current margin. So 11% is the margin. Let me scroll down here. So we don't make any adjustments for CapEx, R&D, acquisitions. We are only docking them credit for stock-based compensation. So normally, stock-based compensation pushes your free cash flow up because you are paying your employees with stock and not cash. So it even though your profits may be lower, because you are paying your employees with stock-based compensation, your cash flow is still pushed up because, it's not cash. But I actually count that against on the free cash flow. So I count 95% of stock-based compensation against that free cash flow number, which gives me a new estimate of 11.18. So I have just the average, this is just their average free cash flow margin over the last 5 years, and they just need to grow their revenue at 2%. And when we look at their past performance, past performance is not a guarantee of future performance, but they have pretty much grown their revenue every single year since 2017. So they have a solid history of growing their revenue. They just need to grow it at 2%. And there is a 116% upside. So let's start chipping down on some of these projections to see what is the market expecting out of Simply Good Foods. So if I drop their free cash flow margin down to 9, below their historical average, and I drop their growth down to 0, 0, 0, 0 growth. So they just have to survive 0 growth with a below average free cash flow margin. There's still a 21% upside. So let me bring it down to 8. There we go. So this is 30, 33, 35% lower than their average free cash flow margin. And we have still a 5% margin of safety. So Simply Good Foods is one of those companies that just appears to be priced for failure. And I don't think that they are on a road to failure. Now, one thing about this company is this is the Atkins company. So they have a few other products, but Atkins is one of their it's a big portion of their revenue, and Atkins is dying. However, they have other brands that are picking up simultaneously. So Atkins is a drag, but Quest Protein and Owen brands is also a boon. Like these two segments are increasing in revenue while Atkins is dying. So the result is, people associate Simply Good Foods with Atkins. Atkins is kind of going out of style. So the stock price has been depressed, but this company makes a ton of cash. And let's see, how do they use that cash? So first of all, here's their operating cash flow. In 2025, they had $178 million come in, only $20 million in CapEx. They paid off debt with it. They paid off $150 million. They repurchased $54 million in stock, and they issued net common stock repurchased. So yeah, they repurchased stock and they paid off debt. And so they don't pay a dividend, but if they're buying back stock, that's essentially the same thing as them paying me a dividend, and then I turn around and use that dividend to buy shares, except now I don't have the tax burden. So I'm happy with them using their free cash flow to buy back shares, especially because I have this company as undervalued. If I had them as overvalued, then I would not be as I wouldn't be real keen on the stock buybacks. But excuse me. Yeah, their free cash flow yield. This is a big value number right here. This is first for your stock screener. This is one way that you can screen for a whole bunch of companies. It's not the end all be all. Like, you still have to do your due diligence, of course, but a 13% free cash flow yield is really high. And a lot of times that is indicative of a value company. So that's what I'm looking at for Simply Good Foods. If I go to their LSEG stock report, this is another analyst aggregator. So if I scroll down a bit, we can see that their earnings per share is projected to go down in 2026 as well as their revenue is projected to go down, but then the analysts are projecting them to level back out essentially in 2027. Earnings per share start to come back up in 2027. So 2026 is looking to be a rough year. That's a big explainer for why their stock price has been going down. But I think the market has overreacted to this company, especially when you consider the discounted future free cash flow. And actually, let's put in the analyst expectations here so we can see the spread of projections as well. Let me copy that into the spreadsheet because we still have EPD in there. So now these numbers are representing the analyst projections for years 1 through 5, my projection of 0 growth for years 6 through 10, and perpetual 0 growth, as well as a depressed free cash flow margin. And even with these depressed figures, I'm still getting a pretty favorable spread. So the most optimistic analysts, 113%, the most pessimistic, down 21%. So I think Simply Good Foods has a great risk-reward profile. It appears to be very undervalued. Then again, it is a risky holding, and that is why I invest in so many different companies. I have 57 different positions. I'm not putting too much money into any one company because this is, investing is a probabilistic venture. You can never be 100% sure on a company. That is why it is so important to diversify. I want to invest in as many undervalued companies as possible. And then as long as my analysis is strong on average, then I should beat the market over time. And so far, knock on wood, we are beating the market currently. So let's go back to the portfolio. We can compare our portfolio to the S&P 500. So this is basically saying if instead of investing in the companies I invested in, I invested that same amount of money into the S&P 500, and it is tracking how I would have done had I invested in the S&P. And so after a little over a year, we are at 27% while the S&P is at 20. So, okay, that concludes your regular programming. The next thing I want to look at is just a little bit of an update on the cannabis sector. So I'm a big time cannabis investor. For those of you who've been watching my channel for a while, you already know, you've heard the spiel. Cannabis is a Schedule III narcotic right now, which means even though there are roughly half the states in the union have legalized cannabis to some extent, whether that's just medical or whether that's full-blown recreational use, even though like over half of the states have legalized it to some extent, it is still Schedule I currently. And that means that these businesses cannot make the normal deductions for their taxes. So they have to pay tax on their gross profit instead of their net income, which means a lot of these companies are paying taxes greater than 100% of their profits, like insanely high taxes. Normally, I think the typical corporate income tax is 21%, and many of these companies are paying over 100% on their taxes. Some of them are not even profitable, but they still have to pay taxes. So once cannabis is rescheduled from Schedule I to Schedule III, that tax code changes, and now they can deduct regular business expenses. So as soon as this rescheduling happens, a lot of these companies are like in the snap of your fingers. As soon as it is on record and as soon as it is passed and all of the procedure is done, you can snap your fingers and these companies are going to be twice as profitable in some cases, 3 times as profitable. It just depends on, how much profit they had and how much they were paying in taxes. So this is a huge boon for the industry. I cannot invest in these companies on my M1 portfolio because a lot of the major exchanges will not house these stocks while they are dealing in a Schedule I narcotic. But as soon as they're rescheduled and then we start getting some legislation allowing for banking and moving them to the higher exchanges, that will also be a big catalyst for the share price to go up because there will be more eyes on these companies. More people will be looking to invest in them, and that will bring their value up to the fair value much sooner. So it'll bring in a lot of volume, that's for sure. So today we had some news break on Axios that the Trump administration is expected to move to reclassify marijuana as soon as Wednesday, which is today. Now, Trump has already issued an executive order to expedite the process. This has been a process. So the wording here is a little bit interesting. So a lot of people are interpreting this to be that it's going to be finalized, or it's going to be, you know, put into law officially as soon as today. Now, it didn't happen today. I've seen a lot of other people saying that it's probably sometime this week. So because of this news, and it had been an uncertainty because if you are familiar with the history of cannabis rescheduling, there's been lots of ups and downs. It gets a lot of things get promised by politicians and then it gets delayed. And there's just been a lot of people are very skeptical, but this appears to be credible, especially when you look at the price action. So MSOS, this is the cannabis ETF. This is U.S. cannabis exposure. When that news broke, it went up 20% instantly, and it pretty much held all of that today. So MSOS went up a whole lot. Green Thumb is one of the companies that I personally hold that I like on the day. It went up 10%. My favorite cannabis REIT went up 6%. So I was really happy to see this. It's just another indicator that the process is moving along. And these two companies, these are my two personal favorites, New Lake and Green Thumb. These are both not traded on regular exchanges. That's why I cannot purchase them on my public YouTube portfolio, but I do own these names on my private portfolio. And I invest with Charles Schwab. So on Charles Schwab, you are able to buy over-the-counter stocks. So eventually, I'm hoping that these companies will make it to the higher exchanges, and then I can invest in them on my public portfolio, which is on M1, but sadly I cannot yet. So anyway, just wanted to throw that out there. New Lake, Green Thumb looking pretty strong today with this article from Axios. It looks like something could happen soon, in which case, you know, as far as the short-term price action, who knows? I'm not going to tell you that these stocks are going to go up more whenever it gets finalized. I mean, just based on past performance, it looks like that may be the case, but that's not my investment style. I'm not looking at technical analysis. I'm looking at the fundamentals, and I see, based on my assumptions, that New Lake and Green Thumb appear to be undervalued. And hey, Hokaja, yeah, I see that you saw the cannabis stock price action. Yeah, I did do NVO, and you just reminded me, Hokaja, I need to look at NVO really quick so we can see where it's at today. NVO, let's go ahead and look at it on our holdings and see what it's sitting at. Or I'll go to activity. NVO. So we bought November 24th, and it looks like we just bought a tiny bit more in January, and then we saw a dividend, and that's all we've done with that particular holding. So let's look at it here. Oops. Need to filter by name. Okay, so we are currently down 11, almost 12%, which is sad because at one point we were up quite a bit. I think I remember it coming down quite a bit recently. Let's see. Yep, so in the last 3 months or so, it was up at $62 and it has come down quite a bit. Has the forecast changed dramatically on this company? I wonder. See, this is the thing about NVO. It has a wide range of analyst expectations, but if we just take the average, it looks like, well, let's just copy it and put it in. Let's just take this right here and put it in the spreadsheet. Yeah, Hokaja, I saw that. Hims is recovering too lately. They are going to do a business together with NVO on GLP-1s. Yep, that is nice. It's nice to see Hims finally in the green on the portfolio. Again, it's sad that they were so high on this portfolio, and I wish I would have trimmed that holding a bit, but we missed that opportunity. Okay, so I'm going to paste this here. I only need 5 years, so I need to paste it there so I can just grab the 5 years, put it into the spreadsheet, NVO, and there is a convert. Oh my gosh. I just realized for this whole stream, I had the wrong conversion rate. 17%. That's embarrassing. So basically every projection was about 17% too high. Oh no. Let's do a quick, before I get into Novo, I can't believe I left that there. before I get into Novo, let me just rectify this. Okay, EPD. Oh, I remember what it was actually. It's 3.5. Let's rectify this really quick. Let me just do a very quick. Yeah, we had 11.5. So my personal assessment is 11.5, expecting to see 0.5% growth, and 3.5, 3, and 3. So with this, so I think before I was saying it was 50% upside. So based on this set of assumptions, it is 31% upside. I apologize. Whenever I'm streaming, I make this screen a little bit smaller so that I can zoom in and it's more visible. And because I had it zoomed in, I did not see that I had my exchange rate changed. So I apologize. So 31% buffer on EPD, given that it is an exemplary capital allocation, wide moat, moderate risk or moderate uncertainty. I'm happy with a smaller margin of safety on this company because it looks really good, and I think it has some really nice macro tailwinds associated with it. So I apologize. On Simply Good Foods, it is not as good as it looked. What did we say on Simply Good Foods? We said 11. And then we said 2, 2, 2. So still a 127% upside, which is really strong. Oh, wait. No, I got to do this. An 85% upside, which is still really strong based on this set of assumptions. To see what the market classifies this company at currently, if we drop it down to 9 and 0, 0, 0, this is what about what Simply Good Foods' fair share price is. So a reduced profitability and no growth over the lifetime. So as long as this company is able to survive and have reduced free cash flow margin, then it is essentially fair price today. I think the market's overreacting a bit, and so I think this company is still undervalued. Okay, Hokage says, Brian, can I get this spreadsheet, the one with the conversion rate and the bond value calculator one as well? Yes, you can. Please send me an email. I will try my best to remember. I will send you this link with this spreadsheet. I'll reply on the email for sure. Okay. Sorry about that. I had to retrace there. Hopefully people that saw the first part of the stream stay tuned in. Anyway, NVO. Let's check out NVO really quick. And there is an exchange rate on NVO, I believe. Wait. Yeah, NVO. Stock analysis. It's there. Huh. Okay, so yeah, this is in DKK. Oops. Okay, so this is a 0.16 conversion. So I got to put in 0.16. Let's do their adjustments here. So I do like to give them credit for some R&D. It's hard for me to say how much, so I try to just err on the side of caution, only give them credit for 10%. The company like Novo, they're constantly trying to improve their pipeline. So reinvesting in their pipeline is a huge source of future free cash flow for them. So I got to give them some percent. I don't feel like I have a great way of estimating how much of their R&D I should give them credit for. So I just, I try to keep it smaller. And then I will be giving them credit for 45% of their CapEx. And that would give me a free cash flow margin of 37 to 38. So that is much better than what I have in there. We'll say 37. With their current level of profitability and zero growth, I have them at roughly fairly priced right now. This is their, I do believe I put in their free cash or their analyst forecast. Let me just double check. Yes, 5.6 and 14.2. Yes. Okay. So this is the spread of analyst projections. Let me just up this to a minimum of 3% growth. Well, no, we'll do 2%. So if they're able to just grow their revenue by 2% going forward, I see an upside or a margin of safety rather of 59% based on the spread of analyst expectations. The most pessimistic analysts, I'm showing 24% overvalued with a 325% as my maximum upside. The truth is more than likely somewhere in the middle of this. So potentially a 73% upside. So I think Novo is still looks to be incredibly undervalued, just based on, and this is based on the analyst expectations and then them maintaining their current level of free cash flow. So let's start chopping it down. Let's say they lose 20% of their free cash flow. They drop down to 30% with just bare minimum revenue growth. There's still a 27% margin of safety. And if we look at their past performance, this is a company that has been growing their revenue virtually every single year since 2009. There was 1 year right here where they were virtually flat. They have been consistently growing their revenue. So I find it incredibly unlikely that going forward, a company that's averaged double-digit revenue growth for the last 5 years, that they're only going to be able to grow their revenue at 2% going forward. Excuse me. I just don't see that as likely. So I think that this set of assumptions is very conservative, and I'm still seeing a margin of safety. So I'm going to stay invested in Novo. I think it is it's a relatively safe company to invest. A small percentage of my portfolio, I'm going to stay invested, and I may add to it over time, especially if they keep dropping. I mean, this is a solid margin of safety. So especially for a reduced free cash flow. So that's all I got for today. Yeah, Hokage, please send me an email. I will reply to it with this spreadsheet. And yeah, that's all I got for y'all today. Again, I am sorry for the exchange rate hiccup there. Hopefully everybody who is watching at the beginning will hopefully tune back in at the end and see that I have, corrected the exchange rate problem. It's my bad. Okay. All right. Like I said, that's all I got. Hokage, thanks for tuning in. Mr. Grizzly, thanks for checking in at least. I'm sorry my stream time is not compatible with your time zone. Yeah, I don't blame you for not wanting to stay up at 2 a.m. to watch the stream. That's fine. You can catch the VOD on YouTube. No big deal. And yeah, I'm going to keep watching cannabis. Hokage, are you invested in either of these two names, New Lake or Green Thumb, or are you doing mainly MSOS? I'm curious what your play is here. Green Thumb and New Lake aren't the only two solid names in the space. They're my personal favorites. But I'm curious what other people are doing here. I really like that New Lake has the 12% dividend because there's been so much uncertainty in this space. Being able to invest in a ticker that is a strong company and it's undervalued, and whether or not the market gives them credit, they're still paying me money every single quarter. So that's what I really like about New Lake. And then Green Thumb is, in my opinion, the strongest out of all of the big MSOs. They're actually profitable even with the crazy 280E tax rate, which I explained a minute ago. Let's see. Yeah, we can see there. Let's go back to 2023 as an example. So their pre-tax income was 150 million. Then they paid 118 million in taxes. So normally it would be 20% or 21%, which would be roughly 35 million. This is 118 million. So they're paying 20% of this number up here, gross profit. So makes a huge difference. Most recently, it's not as extreme. I believe Green Thumb stopped paying 100% of the 280E taxes because they're expecting this tax burden to go away. And so I think if we go to their balance sheet, we can see that they still call it out as a liability, long-term deferred tax liability. And yeah, it went up quite a bit. This is that $220 million. And this is where they're not sure if the IRS is going to make them pay all or some of this, because it's a little bit hazy on the rules. So this is a liability that they may have to pay off. It may go away. And that could be another potential little boon to the company. But Yep, that's all I got for y'all today. Thanks for tuning in, and I hope to see y'all next Wednesday, 6:30 p.m. is when I'm going to stream next Wednesday. I'm going to try to, I think 6:30 is where we're going to stay. We started at 7:30. We've been slowly moving it up. I'm going to try to stick with 6:30 p.m. from now on Wednesdays. So, hope to see y'all there. Good night.